All right, a tax break included in the tax bill has spurred a boom in opportunity zone investing. Let's talk about where the money's going and how investors can get involved. DLA Piper partners Jerry Neuman and Paul Wassgren join us now in the studio. Gentlemen, thanks for coming in. We've heard a lot about these opportunity zones, right? And there's a lot of anecdotal information out there about where they're being deployed. Give us some examples of where this investment is going.
So you're seeing investment all over the place. You're seeing it we have clients in Denver, we have clients in California, New York, across the country where they're investing or finding places to invest. Investments happening in Birmingham and Salt Lake City. I mean, throughout the United States, we're seeing that. And it ranges. I mean, there's a map that shows where investments can be made, and from that map, people are going out and looking for property.
But as an average investor, how much money do I need? Could I get in on this, or is this really only for the top 5%, 1%?
Well, let me take a stab at that. In my experience, certainly these deals require a certain economy of scale, but if you're an individual investor with a modest capital gain, you can still invest in a syndicated offering as one of many investors in one of the larger projects. And we've seen quite a bit of that, actually.
So you have to pool maybe 20 people together to raise, what, a minimum investment of $1 million?
I would say closer to $5 million to make this make sense.
But you see funds all over the place that are being developed and asking people to invest in those funds. And then those funds are going out and seeking the opportunities.
So one of the criticisms that has been leveled at the opportunity zones is that they're not necessarily helping the people they were designed to help or the areas they were designed to help. If you look at that map that you referred to, that you can choose from when you're making these investments, the way it was drawn, some of them are not necessarily low-income areas, or certainly some of them are completely separated from low-income areas, and some of them only a small portion of the geographical footprint is in low-income areas. So one of the knocks on opportunity zones is that the money is not being deployed to whom it should be deployed.
Well, I think you have to look at this as a distribution issue, right? And you find that these opportunity zones have elements of being in areas that are, needing redevelopment, and you're finding that their map was drawn that some areas maybe are not as needy of redevelopment. Some of that is historic. Some of these areas were once really downtrodden and now have started to come back, but some of the historic data has led them to be included in a map. So from that, you're seeing that we're getting involved in looking at where it's going. We're seeing that the map will change. They're seeking information about where the money's being deployed. And I think over time, you're going to see a change. It's a new program right now.
Well, one of the concerns that we always have when we talk about opportunity zones to our clients is, number one, if you're investing in a pooled funds, odds are you're not getting the best real estate out there. Real estate has always been about location, about being very specific and tactical in terms of buying it. So we advise investors to actually be very careful when looking at funds, not to mention that you've got fee upon fee upon fee. I want to talk about something slightly different, which is, how important or how do you weigh, when you guys look at these opportunity funds, the tax benefits, and do you allow the tax tail to wag the investment dog, so to say, and overweigh that, and where's the risk there for investors?
Well, I think it's important to note that this is not a tax program that makes a bad deal good. This is a deal that makes a good deal even better for investors and sponsors and developers like the clients that Jerry and I represent. But it has attracted capital to areas and projects that would otherwise not have been funded, but for the 2017 tax reforms.
And I think what you're seeing is that Paul's exactly right. It's not making a bad investment better, but it is allowing, a bad investment good. It's making a good investment better for many people.
So why are they getting such criticism? I mean, I'm used to the old-fashioned TIF financing, right, but this allows people with higher incomes, let's be honest, to get in. It seems as if the criticism might be justified. Why these opportunity zones are coming under a lot of criticism, as Julie said, and why is that wrong?
Why is the criticism wrong?
Yeah.
I think any criticism isn't wrong per se. It manifests itself in a way of reflecting or upon what is being done right and what is being done wrong. I think the criticism can be classified as unfair at times because as this program is rolling out, what you are seeing is investment into inner cities, investment into poor areas, and in that opportunity, those areas are getting better. Is it also being invested in areas that are not as downtrodden? Absolutely. And that's where you have to re-examine and see where it goes. So the criticism should be, as we move forward, and as another iteration of this comes forward, how should we look at it and where should that money be invested? And I think that's a fair criticism.
All right, thanks for coming in, guys. Appreciate it. Jerry Neuman and Paul Wassgren. Thanks.
Thank you.